Europe has a problem, a structural gap in its natural gas supply. Domestic production is in long-term decline, import dependency is high, and energy security has become a policy priority right across the continent. Against that backdrop, a small Canadian company has quietly assembled one of the largest contiguous gas land positions in Hungary. Independently evaluated at a risked NPV10 of over 1.7 billion US dollars. The company is CanCambria Energy, and we are joined by CEO Paul Clarke, a petroleum geologist with 25 years of experience, including senior technical roles at Pioneer Natural Resources and Ultra Petroleum, across some of North America's largest unconventional gas plays. Paul, welcome. So let's start at the beginning. Tell us what CanCambria does and why it matters.
Yeah, it's great to be here. Yeah, we are a E&P company. What that means is exploration and production. So our business model is to find prospective land positions where we can go in, we can identify oil and gas in the ground, we can characterize the resource, then we can go drill and produce. So we are really a drilling company. We have a business model which is based around low cost entry into profitable markets. Where it's relevant to your audience here is we assembled a very large position in Central Europe. So we've done the due diligence. We picked up the acreage at a relatively low cost, significantly low cost when compared to North America. And we have a very aggressive growth model which calls for drilling as early as the turn of the year, and then a 3 to 5 year plan which has significant free cash flow generation, drilling upwards of 25 to 50 wells over the near term. And frankly, Europe needs natural gas. And we'll unpack this a little further. They're in the middle of a very significant natural gas supply crisis as a function of the macro, both Ukraine, Russia, and also the issues affecting the Middle East, in addition to more broadly energy policies across the EU.
Thanks, Paul. That's a really useful overview. So let's drill into Hungary. When you first looked at the project area there, what was the insight? The thing that made you think this could actually be commercial? Something the previous operators either missed or just didn't have the tools to act on?
Let me tell you what we aren't. We're not the classic greenfield exploration, deep water, or the middle of the desert trying to figure out if oil and gas is in the ground. What we have is a business model where we enter proven basins, basins that have produced hundreds of millions of barrels of oil and gas, typically conventional, and then we apply modern techniques, technology, best practices, largely targeting the unconventional part of the resource in order to really improve recovery efficiencies of maybe stranded or bypass pay. So with respect to the project in Hungary, there are a handful of wells that were drilled within this Pannonian Basin, this Kiskunhalas Basin, most of which were drilled in the 70s and the mid 80s. A couple of those wells in our general backyard produce gas to surface. The most recent of those produced gas in 2009 through 2011 when gas prices were in the region of $3.50 per MMBtu. So there is also a component of price. These unconventional plays are typically a little more capital intensive. So it's a combination of price, but also lessons learned in other basins. What are the key drivers that will make a project work versus maybe those that won't. And we'll unpack that a little bit later as we go through the interview.
That's a really helpful distinction on the approach. So let's talk pricing, because this is where it gets interesting. Right now, European gas is trading at many multiples of what it costs in North America. Walk us through that. What's the price story here?
That's right. Europe is probably the most attractive market anywhere in the world for E&P companies to operate. We entered with a 5-year plan on the heels of Russia-Ukraine in 2022. Prior to that, natural gas was in that $3-4 $5 range for a number of years. And this was really a structural reset once plentiful Russian natural gas was off the market, either a combination of politics, more significantly longer term infrastructure damage as a result of the war. Natural gas kind of reset to this $10, $11 per MMBtu price point. For reference, North America, 250, 275 as being kind of the typical price point. So yeah, there's a very significant supply side issue. Demand is relatively flat, but on the supply side, we then have here recently, through the early part of this year, LNG curtailments from the Middle East. Russia, of course, had the impact, and then the US-Iran conflict. A lot of the natural gas replaced from Russia is coming via LNG from the US, and a certain amount from Qatar. And now a lot of pressure to get LNG, not just to Europe, but to Asian markets too. So really that's put natural gas, as of the last couple of days, trading in the $14, $15 per MMBtu price point, which is a 4 to 5-fold increase on the US. Our break-even project economics are based around a $3.75, $4 gas price. So the gas price is, I think, structural. I think it's here to stay over the longer term, certainly the life cycle of a project like ours. We run all of our economics on a $10 price forecast. So yeah, there's as I said, a good number of reasons to be very optimistic about energy and the demand and the need for energy in Europe.
Those are big numbers at the macro level. Let's bring it right down, though, to a single well. Given that shift in gas prices, what does the pricing differential actually mean in dollar terms for one producing CanCambria well?
Yes, so if we strip it back to just the gross revenue, we have a production model per well based around geologic parameters and engineering parameters, which provide a type curve in the region of 4 to 6 BCF of natural gas plus liquids. So that is a vertical well, multi-stage completion. On a gross revenue basis, that delivers somewhere between 60 and 100 million US dollars. Now, there are a number of factors that play into that. CapEx to drill the well, operational expenditure to bring on the gas and production, tie-in, etc., a little bit of tax and government take too, but that gives you kind of the sense, 60 to 100 million based around a price in the region of $10 to $12 gas. For reference, that same well in North America might have revenue in around 15 to 20 million. So a very significant price premium around the production of these wells. Importantly too, these unconventional reservoirs typically have very high initial rates. So not only is the revenue very strong, but also the payback on these wells is quite quick. We have, on a $10 gas price, payback is less than a year on a well that we think costs somewhere in the region of 15 to 18 million US on a per well basis. So very, very robust, very strong economics per the wells that we are anticipating to deliver.
Those are strong economics. But of course, none of it works without the right team behind it. And your team's drilled over 1,000 horizontal wells, Eagleford, the Permian, plus vertical wells up at the Pinedale anticline. So why does that specific experience matter for what you're doing in Hungary?
Absolutely crucial that we employ the lessons learned. We've spent, decades of experience, hundreds of millions of dollars working through what a successful project looks like, what are the key attributes that one would look for in these types of plays. And I have the discussion with senior executive board of directors on countless companies where we talk about field trials and then they talk about trial and error. But we've done on all of those companies huge value creation in the Eagleford and the Permian. And so we have a lot of lessons learned. We know the key tools to employ. We know the toolkits that work, some of the pitfalls and problems, etc., going forward. So those assets with larger companies really prepare us for what we anticipate doing in Hungary. Probably even more important as we move through commerciality, the field in Wyoming, the Pinedale anticline, that proves to be a very good operational analog too. So the well design is very similar. So a lot of the cost savings that were realized in that field with Ultra Petroleum, those can hopefully be deployed in Hungary, so we can bring down the well costs. We recognize that $15 to $18 million for a vertical well is rather expensive, and we would hope to bring those costs down further. Of course, the economics support that, but that, you know, the cost and the capital and the efficiencies there is the next challenge that we have once we demonstrate the technical and commercial merits of the field.
That track record clearly matters, and so does having the right people locally. Pete Van Assa, your COO in Budapest, he's actually worked the Kiskunhalas Basin before. Real in-country experience. So in practice, what does that boots-on-the-ground knowledge actually give you?
Oh, it's huge. It really is huge. Not just the language barrier, as one might imagine, but in terms of credibility in the local jurisdictions, the regulatory, the ministry, etc. Absolutely essential. He has a small group of technical and administrative staff in our office over in Budapest, and I think that is essential for us to operate. I'm over there each quarter when we start drilling and working through the project. We'll have a number of US-based folks on the ground supervising operations, so on and so forth. But really the connection into the ministry is really important. Pete and his group also are very familiar with the regulatory landscape there, the right people to call, and also the consulting folks on the ground. I don't think you can get much done unless you have strong relationships in country, especially as we have a business model that is based around, employment, or the deployment of North American expertise. We can't forget both the local knowledge, the local experts, and also, frankly, some of the local geology is really, really important too. If we don't do our homework and figure out where to apply those technologies, it's all for nil. So it's, there has been in the past some companies that would work through Europe deploying, a similar technological mindset, but if it's not done to the right extent within the right basins and the right formations and geology, then it really doesn't count for a great deal. So the technical merits and the local knowledge is also still very, very important.
Let's zoom out for a second to location itself, because Hungary, it's not where most investors would instinctively look for oil and gas. So why do you actually believe operating here is an advantage, commercially and practically?
As we said on the introduction, Europe is probably the most attractive E&P place to deploy capital. Really, really strong natural gas prices and oil prices too, which of course is a little more global. But as I'm sure you're well aware, and your audience may be well aware, there are not many jurisdictions in Europe that welcome oil and gas companies with open arms. And so, Hungary, thankfully, is one of those jurisdictions that really recognizes the need for a very coherent energy transition. What that means is managing the pace at which those alternative energy sources come on stream. And natural gas is really important to that. So yeah, Hungary, great place to operate. They're very welcoming. By way of example, we permitted our 3D seismic survey. The 3D survey was really instrumental in defining the main sweet spot that we're looking to drill. We permitted that within about a 3-month period, very, very quick, no damages, etc. So they are very receptive and very welcoming of the investment. In addition to that, and equally important, the fiscal terms. The tax rate is low. VAT, albeit a little higher than some European countries, but the royalty the government take for these projects is very, very low. To generate the investment into these unconventionals, the government take just 2% royalty, which means we as a company get to retain 98% of the product that we produce. So when you consider that the natural gas prices are very, very high and we get to keep 98% of the product, as you might imagine, the economics really do fly.
Great context on the jurisdiction. Now, the tight gas play is clearly the main focus, but you've also got a shallow oil opportunity right next door on the adjacent land. So how significant is that really? And what's the timeline for working out what it's worth?
Right. Our business model when we come into these areas, much like we did with our tight gas players, evaluate the existing data, identify the opportunities, recognize deficiencies in the data set. So for our deep tight gas play, we acquired a new proprietary 3D seismic data set, then we base a lot of the resource evaluation on that data set in combination with the well logs. And we are doing exactly the same philosophy on those adjacent lands. We do see deep tight gas potential in the concession, but similarly, there's quite a lot of opportunity in the shallow oil pro window. It's an area that has produced several tens of millions of barrels of oil and significant amounts of gas over the late 70s through the early 80s, and then once Hungary became an independent country there, they really didn't invest or continue to invest in the region. So there was no 3D seismic deployment in that region. So our vision here is to come in, integrate the well data, acquire the 3D seismic data. We look to do that later this year, hopefully in September. Per our contract in country, we were obliged to acquire data in 2027. With oil prices where they're at, makes sense to do that quite a bit sooner. From when the seismic data, the tapes are in the can there, and the data starts to be processed in Houston, takes about 9 to 12 months in order to identify the drilling locations. So our thought process here is, when we're looking at around, Q3 to acquire the data this year, and then second half of 2027 to potentially drill a number of shallow, by shallow I'm talking 1,200 meters or so, oil wells that have some significant impact, very quick to drill, and very, very economic at $100 oil.
That's interesting. Let's jump back to the tight gas project now and talk infrastructure. Because the Jana storage facility, it's accessed by a pipeline right inside the field. So once a well's producing, how quickly could you actually move from first flow to first revenue?
And that's another key attribute to not just the deep tight gas play, but the more broadly the oil play in general. There's given it's a legacy producing area, there's a huge amount of infrastructure with spare capacity. So, we have options. Work with a couple of different companies. At least for the first 3 appraisal wells we plan to drill, that gas storage facility is a very viable option. That small pipeline will take gas almost immediately, so we won't be flaring. We'll be testing the wells for a short amount of time and then putting that gas through to the storage facility within the field, and then trucking via railroad the liquids up to either to Budapest, where there's a refinery, or some of the other processing facilities in the same general region. So yeah, the infrastructure is good. Access to services is also quite good. There's the usual suspects of Schlumberger and Halliburton in the region. So yeah, a lot of positives for the project.
Thanks, Paul. Let's talk funding. You've brought in Raiffeisen Bank International to run a farm out and JV process. So tell us about that. What does engaging a Central European investment bank actually signal about the asset? Who's the ideal partner here? And for shareholders, what would a good outcome look like?
Yeah, it's a very standard procedure. Most companies of our size, even companies that are quite a lot larger, will tread this path. They will walk through. The project is fairly capital intensive. Once that commerciality is demonstrated, the inventory of drilling locations is very strong behind that. So I would say a strong European bank was essential to find the right strategic partner. I think drilling those first 2 wells ourselves as a small pre-revenue company would have been quite difficult. North America, we thought would be an area that had interest. It turns out some of the feedback we've had, we'll likely find a strategic partner over in Europe. They are just so much more aware of the natural gas crisis in that part of the world, and less sensitive to some of the perceived political risks in the region. The process we started with Raiffeisen, we are probably 2 to 3 months away from a conclusion there. We had a data room open, which really is now closed. So we are beyond the technical part of that process, and we're in the commercial discussions. Again, we had a lot of inbound from smaller companies. We were looking for a more strategic partner over the longer term. It makes more sense for us to be in the project for 3, 5, 6, 7 years. It's not something that we wanted to drill 1 or 2 wells with a partner and then be asking the question of what next. So a strategic large partner that validates all of the technical work and adds credibility to the project. So that's really what Raiffeisen bring to the table.
That's helpful context on the JV process. There's also a pretty striking gap here between the company's valuation and the independent resource estimate. CHPE's evaluation puts the risked NPV10 at over $1.76 billion, against a market cap that's a fraction of that. So, in your view, what does that gap actually represent, and what starts to close it?
Yeah, that's a good a good question. That's a question I get all the time as we go through the deck on the asset and the company. We had those key wells within the field. So we had a couple of wells with logs, with core. Those wells had produced gas to surface. One well actually produced gas for about 6 months into that same gas storage facility. So we had the subsurface data. What we didn't know was the size of the accumulation or even the sweet spot. So that's where the seismic data came in, the proprietary seismic data. We invested a little over 3 million into that data set, which really backed up these resource numbers. Again, we're not talking about proved reserves or production. We're talking about resource numbers, risked contingent, meaning yet to be commercialized. So the challenges you describe is market cap on the one hand versus asset size on the other. So really the only way to move along there is to drill and to then operational success, drill the well on budget, technical success, demonstrate the subsurface model is working. We encounter the amount of gas pay that we think, and then commercially the wells produce at the rates, recover the volumes, drain the areas that we think. So that's really the timeline. Well, that's really the technical workflow, the timeline. 2 months to drill a well. We'd like to have a rig in the field continuously to drill. We have a model whereby we're drilling between 5 and 7 wells per year, growing revenue in the region of 300, 400 million per annum. So a very strong 10-year growth story. But it really all starts with funding those first 2 to 3 wells. And so I think in terms of the market looking at CanCambria, how do we fund, how do we finance those initial wells? Per our Q1 numbers, we have about 1.5 million cash on hand, a further 2.5 million of restricted cash over in Hungary. So, our ability to execute on the JV is very, very important to get those initial wells funded. The project, I may say, is self-funding really from well 3 to 4, depending on the rates and the recoveries. So say conservatively well 4. So we have what you might consider a funding gap of around 3 wells, and that might represent somewhere between 40 and 50 million US. And so naturally that is the exposure that we're looking for or to cover with this joint venture process. And so that would be the first step in order to realize some of that value is funding those initial wells, and then delivering on what we say, putting the technical work into practice and getting those wells producing and flowing to sales.
Those are the numbers people will be watching. But let's be straight about where you are. You're pre-revenue. You're asking investors to back you before the first wells even prove the model. So what's your message to the people who are wary of junior E&P companies like yours?
Yeah, we've done the due diligence both on this asset, and we've we've had the hard knocks on other assets too. The team that we've put in place, both the leadership team and our board of directors. We have go read the bios. We've done a huge amount of very strong work throughout the industry with larger companies, delivered huge shareholder value at billion-dollar corporations. So I joined the company 3 years ago to lead as a technical challenge and a commercial challenge to expand my career. So we are successful when the company is successful. We will be judged by our results, but our track record, I think, is second to none. We've done this type of project numerous times before. And of course, there's a lot of homework that individual investors need to do, because there are a number of companies out there that may be a little more promotional. We back everything that we say on science, and we put our dollars behind that. We invested as a private company in the 3D seismic data set that better delineates the fairway. So yeah, we've done all the right things technically and operationally to stack this up such that a large multinational oil and gas company could look at this once it's proven and commercial, and be very much very interested in this as a growth vehicle going forward.
That's a fair message. So let's look ahead. The next 12 months, the JV announcement, the well spud, first flow, first gas sales. Investors are watching for catalysts. So which of those do you think matters most to the market? And realistically, what's the timeline on each?
I think in sequence they all carry essentially a incremental but similar weight. We can't really even speak to the productivity of the wells until the wells are funded. So first and foremost, we get the joint venture delivered, we get the wells funded, we get the wells on the drilling schedule, permits are approved, and everything in that regard is good to go. So I would hope by Q3 we have the funding delineated. We'd like to spud the well, at least the first well, through the turn of the year, with production Q2, Q3 of next year. It will take a while. These wells IP at high rates. It might take 2 to 3 months to understand the longer term recoveries on a per well basis. But yeah, I think within 12 months to 18 months, we'll really have the visibility into how much of that 50 well inventory we can consider to be de-risked. We'll convert over those resources to proved and probable reserves as is standard within the industry, and we'll keep investors updated as we go. I think as we've traded here over the last 3 to 4 months, the market is definitely looking for some direction in terms of that JV, and we hope to get that wrapped up really by September.
So plenty of near-term catalysts to watch then. Let's end by zooming right out. 5 years from now, if everything goes to plan, where do you see CanCambria?
Good question. Yeah, just the easy ones here, right? So for a pre-revenue company like ours, capital is absolutely essential. There are a number of other really good opportunities we've identified in Hungary and some of the neighboring countries there, but they all require capital to get the ball rolling. The same business model, deploy appraisal via 3D seismic, etc. We like to be able to buy production. That's another vehicle by which pre-revenue companies can start to move forward. So once we get our deep tight gas play moving, in parallel we have some success with our shallow oil play, and we start to bring in some revenue. There are a number of very good opportunities in the region. We don't think we need to look much beyond that Central European region at this stage. A lot of very exciting opportunities once we start spinning off free cash flow from operations. Of course, we'll keep shareholder value front and center, return money to shareholders where appropriate. But there are a lot of good opportunities for a small, agile company like CanCambria. Those opportunities that are missed by the big guys and really aren't identified by some of the smaller companies that don't have either the breadth of experience and the creativity and frankly the experience that me and my team have. So yeah, lots to look forward to.
That was Dr. Paul Clarke, CEO and President of CanCambria Energy. You'll find the company on 3 exchanges: CCEC on the TSX Venture Exchange, CCEYF on the OTCQB, and 4JH in Frankfurt. So what should you be watching? 3 milestones: the JV partner announcement, expected in the second half of 2026, the first well spud, targeted for the fourth quarter of 2026, and first gas sales, expected early 2027. For more, visit cancambria.com. One important note before we go: this interview is for informational purposes only. It does not constitute investment advice. Make sure to subscribe to Value the Markets on YouTube for more investing insights. Thanks for watching.